I can't back it if I don't know what it is. And seriously, I felt really awkward. I've had a few instances where that's been the case. And I thought, oh gosh, I feel a bit daft here because, they're exceptionally intelligent and their product is phenomenal.
Hello, and welcome to the Scale, Structure, Sell podcast, where we help ambitious management grow and exit their companies. And today my guest is David Goodall, who's a fund manager at FW Capital. Hi, David.
Hello.
In every episode of this podcast, we aim to answer a question that we commonly encounter with our clients. And that question today is, I want to grow my business. How can I find the cash to do so? And I couldn't think of a better guest than David, with something like 40 years of experience in banking and commercial finance. You've met thousands of clients over the years in this situation. What are your main thoughts for them?
Well, for me, it's really trying to demystify the type of funding that is available, but also to explain to them that it's really important to understand where they are in their business journey.
I think it's fair to say that the finance world has become more complex over the past kind of 10, 15 years, and there's a lot more options than there were previously, even accounting for the fact that business owners are busy with lots of different issues aside from finance. So how do you start to go about kind of explaining the options open?
For me, it's about understanding exactly where the business is in its life, because that will really determine the type of finance or funding that is going to be appropriate to them.
How do you roughly break down where a company might be in its life cycle?
Initially, a company might be very, very early stage, and it may actually be absorbing more cash than it's actually making.
Yeah.
Thinking about a lot of businesses, when they're starting up, there's a lot of cost that goes into actually establishing the business in the first place, getting the idea, getting the concept, maybe buying stock. So it can be a little while before actually the company is making any money.
And at that stage, a lot of founders are kind of vulnerable. They know a lot about their product or their service, but not so much about the commercial context. And sometimes they instinctively reach for the equity lever, encouraged by the likes of Dragon's Den. What's your advice typically to those business owners?
I'm a real advocate around people taking guidance and advice and talking to people about what options might be available to them. Those businesses are at a very early stage, in a lot of cases, are almost scrabbling around to get as much cash together as they can from whatever source. In a lot of times that's maybe from friends or family. It may actually be their own cash that they've accumulated, saved up, and are putting into the business just to get it off the ground.
So what's the worst and best thing that a director can do when they're at that stage? They're really desperate to have capital to get off the ground.
The worst thing is just to take any funding that they see first off.
Sure.
And just to go for the first element of cash that they can see and they can get their hands on, because that might not necessarily be the right form of funding for them.
Sure.
It's about taking that advice from people around them, professionals, to understand exactly where the business is in its journey and what funding mechanisms might be appropriate. As I said, a lot of times businesses are going to start off with their own money, friends and family. Sometimes people say I'm fools because the early days of a business can be incredibly risky, especially if there's a new product being developed, you don't have the proof of concept and it's an idea. So trying to raise money in those situations can be quite challenging because the risk of that is very high.
So what's the point at which businesses should be thinking differently about their financing?
Throughout the whole life of the business, the business needs to be attuned to what sort of cash is available. So as I talked about, that early stage funding, or it's called bootstrapping is a technical term for it, where they're trying to get money from anywhere. I think when the product is slightly more developed, then they need to then look at what other forms of capital might be available to them. And in a lot of cases, that might well be equity, actually, especially if it's a company that is still not in a position where it's generating any cash. Because for me, if you're looking at putting debt into a business, the business needs to be able to afford to repay that debt. It's not like you having a personal mortgage. You need to have an excess of income over expenditure to be able to make your repayments on your personal mortgage. If a business isn't in that phase at that point, well, debt probably isn't the right thing. And I can come on to when debt is going to be appropriate, but other forms of funding could well be more appropriate in that situation.
So what a lot of FDs or business owners find themselves doing is kind of wrestling with the terminology in the industry, where we refer to terms that might refer to certain types of businesses or their stage of growth, but their meaning isn't always obvious. And we hear terms banded around about Series A, Series B, and a host of others. Can you chat us through the key terms, and then we can go into what some of those mean?
Yeah, of course. The terms that people would tend to use are, I think, overly complex sometimes. And when you have a business that is really new to raising finance, it might be the first time they've ever done it, some of the wording that I think we as finance professionals use sometimes can be a bit intimidating.
Sure.
And I like to try and demystify those if I can. So things that you've mentioned, pre-seed funding, seed funding, Series A, Series B, Series C, that actually mean a lot to new businesses. It's a new world to them.
Yeah.
And I do think it's incumbent on us to actually just make it a little bit more simplistic.
So can you list the different stages that those terms allude to? Obviously, we don't need to use those terms because they can be confusing. But what are the indicators of different stages of progress for a business for you?
Well, if I look at pre-seed, that's really early stage. I used that term bootstrapping earlier, which is that friends and family cash. That's also known as pre-seed. Okay. Seed funding is typically when the product is slightly more developed, and it's that first stage of funding outside of friends and family that might be through an institutional fundraiser, could be through an angel, for example, could be through a VC, it could be through an accelerator or an incubator, something like that. So quite early stage. And very simplistically, Series A, B, C, etc. are the follow-ons to those. As a business gets more mature, as it maybe becomes more credible in the market, as its product becomes more well known, it starts selling goods or services, then those Series A, B, and C will sort of follow it through that life cycle of growth. The funding initially might be quite small, might be supporting that research and development, just trying to get the company off the ground, that proof of concept type of thing. But as that is done, if the proof of concept works and there's a market for this product, then an investor might put more money in. That could be Series A. If they're ready to go to market to actually get this out into the marketplace, Series B could come into play. And there are funding levels that are associated with these different levels of seed rounds. I don't think it's necessarily that important to worry about that, if I'm honest.
So two terms that are probably familiar to most business owners, if nothing else via kind of, watching the US tech scene or watching Dragon's Den, is the two terms of angel investing and venture capital. What are the difference between those two fields, or are they synonymous?
So an angel would tend to be an individual or a group of individuals who have the ability to invest in companies. Sometimes they may be entrepreneurs who have exited businesses, but the dynamics would be that they are likely to have a high level of business acumen, so know a good business from a bad one, and have the available resources to put into the business for a share in that business. Sometimes it will be an amalgamation of angels, so an angel network, for example, which are quite common. They may have a personal interest in a particular sector, which makes them more keen to invest in that particular business because of the sectoral understanding that they have. But ultimately, they're looking for growth. They're looking to fuel growth by putting their personal cash in for a share in the business and ultimately a return.
And sometimes those investors can be motivated or supported by tax breaks, which are purposely designed to support younger companies. So we've spoken about angel investing, which is quite junior companies being supported by entrepreneurs, whether solely or in a network. How does that differ from venture capital?
So venture capital is an institution that will be looking to invest in companies with really good scalability. Typically, the VC would be at a higher investment level than an angel. Sometimes they will work collaboratively, so you might get a mix of angel and VC.
Yeah.
And that's actually becoming a little bit more prevalent, certainly from what I've seen. VCs would tend to get involved at maybe at the lower end, $250,000. And again, that dynamic has shifted a little bit to go a little bit lower than maybe we've seen historically.
Yeah.
But they will then follow the company as the company develops and grows. Ultimately, they're going to look, though, to invest in businesses with great growth credentials and possibilities. The VC will take a stake in the business.
So with venture capital, we're usually trading equity for money to support growth. What are typically the trade-offs in practice with angel investing or venture capital?
The trade-off, firstly, is the equity. You have to give a little bit away. And certainly some founders are very reticent to do that, which I do understand. However, it's a really good way in many cases of growing your business and getting an exponential return on your own investment in the business. So that is a big trade-off. Some entrepreneurs also feel that there may be quite a lot of interference by the investor. In my experience, I've not necessarily seen that, because I think the VCs and the angels are investing in the people, the founders of the business, who have this incredible idea and want to grow it. I would say that they're there to support, but to help the entrepreneur in that growth aspiration.
With a good deal, hopefully you find a partner who not only has the money and the will to support you, but potentially also a track record themselves or expertise on hand to kind of help develop your business and help to support the growth that you want to see.
I think there needs to be a really good fit of people. And if I were an entrepreneur, for me, it would be looking at who do I think is the best partner. Not necessarily always the case of who's going to give me the most money for the least amount of shares. It's who's going to give me the best guidance and support to enable me to do what I think this business is capable of doing. But there will be that trade-off, definitely.
And as we move up in terms of scale from angel to venture capital, in terms of the equity funding, the top of that tree is private equity. Where would you say the dividing line between VC and private equity typically is?
I just think it varies hugely, and it sort of merges to an extent as you go through the upper echelons of the funding requirement. And this is where I think it's really important to take this professional guidance, because the advisory network is phenomenal if you know where to look, and they will be able to guide in the best way as to where you might be able to get the best fit for your particular business. And this is why I'll always come back to use the networks, use your advisors, talk to people to make sure that you're not actually tunnel visioned around your growth and your financing options. You're getting some professional opinion to help guide you, especially as your business grows further and the requirement for funding, either equity or debt, becomes higher.
It's a dilemma for a lot of founders, isn't it? Because they need capital to grow, they need expertise to grow. There's only a fixed amount of equity to share, and it has to be shared not only with outside funders, but potentially also with internal management, who they want, the best and the brightest aligned with them on that journey to help their company achieve its full potential.
Very much so. And retention of top talent is a really interesting point. I don't think a huge number of businesses actually look at that as a method of almost remuneration or benefits to their employees.
Yeah.
They tend to wrestle with salary and that's sort of it, or perks, gym memberships, muesli bars, breakfast, whatever it might be. But actually an employee having some ownership of that business, with the potential for that ownership and the value of that stake to grow as the business grows, can give some really amazing loyalty.
As we've seen with so many American firms where they achieve huge growth, the mentality of the top talent is, equity or get out, basically, because that's how they're incentivized.
I had this last week. A company said, I've got some really top talent. They're struggling because I can't pay on the salary scale as much as they would like, and they're looking elsewhere. I don't know how else to incentivize them. Yeah. And it came to exactly that point. Why don't you give them some shares? Give them some sort of share plan. And they hadn't actually thought of that, and their advisors hadn't really talked to them about that either. So I think it's a great compromise.
Which companies do you think are less suited to the kind of equity funding that we've just spoken about and should perhaps be looking at a more blended approach or leaning much more heavily on debt?
Equity tends to be for those businesses that have got really high growth expectations and a very scalable product or service. Typical SMEs who are maybe operating not necessarily a lifestyle business, but a relatively small contained business, probably not the right route for them as they go through, probably overly complex.
And family businesses for whom that may be a very tricky and contested route to fund.
Very much so. And I get a lot of conversations with companies where they don't want to give equity away. And I understand why they feel that way. It's because of that compromise that we've chatted about. They don't want to do that.
Yeah.
And they would prefer to have debt because they're not giving any share ownership away in that. But sometimes debt doesn't work for them.
Well, equity is not just about capital growth, whether that arrives or not. It's not just about dividends, whether they're paid or not. But it's also ultimately about control. And, that's at a premium if it's a company which you or a small, tight-knit group of people have founded and really want to see to completion.
Yeah. But it's got to be generating cash. So if a business is in a situation where it's generating cash, it's established, it's profitable, then actually there's no need for equity in that because there are other mechanisms that can be used to actually fund the growth of that business.
So we've spoken about kind of equity routes to funding and touched a bit on where debt may be more suitable. What are the broad categories that business owners or their CFOs should be considering?
It's the purpose of the debt in the first instance. Because different types of funding are more appropriate to different purposes.
Sure.
So if you're looking at buying premises, for example, then an overdraft is not the right mechanism for doing that. What you want is a longer term loan that enables you to buy that premises and repay that as you might do a personal mortgage over a period of years, maybe 15, 20 years, something like that.
And where would you recommend short-term finance?
So short-term finance is really going to be effective when there's a working capital need, where the working capital cycle of the business means that actually you might have to wait to get paid for some of the work that you've done. That might lead to a cash flow gap that an overdraft facility may well help. But again, there are other types of funding that can be crafted and put in place to help with those scenarios, like invoice discounting, for example. I don't know if you've come across that before. If you're a business and you sell a product or a service, you raise the invoice, send that to your client, and that might have maybe a 60-day period for them to pay. Obviously, during that period of time, you're waiting for that cash to come through. So invoice finance is where a funder will look at that contract and actually advance you potentially 80% of the value of that contract immediately. So rather than you waiting for 60 days for all of it, the invoice financier could actually send you maybe 80% of that, 85% on day one. So you get that cash in the bank, which enables you to continue trading. And then you get the rest, less your fees and costs when the invoice is actually paid.
When do you typically come across businesses?
At various stages, we come across businesses that are looking for funding for various reasons. That can be when they may be looking to scale quite significantly, as an example. Maybe they're looking to trade internationally. Could be looking to develop a new product, buy new machinery, invest in staff or marketing. A lot of people looking at AI at the moment are looking at how do we invest in making the best use of AI technology in our business. That comes at a cost. How do we fund that?
And how does the differing purpose for that funding change what kind of funding might be most appropriate?
If it's more asset-based, like machinery, then something like asset finance might be a good route to fund that, where they pay it off on a monthly basis over a period of time. If it's more of a working capital type thing, then an overdraft or invoice finance might be a more appropriate way of doing that. So the funder would look at the request and go, right, what's the dynamic and what is the best route to actually get that funded the most effective way for the business?
And if I'm looking at a large capital project, whether that be a new property purchase, investment in AI or significant scaling, What are typically the better options for FDs and business owners?
Yeah, bigger capital assets, a longer term loan is the most appropriate way of doing that in all likely circumstances. I think you've got to look at affordability in all of this, really. So paying a significant amount for a commercial premises, for example, could completely deplete all cash resources in the business, and that's where loan funding might be appropriate. And if the company is massively profitable, it's generating a lot of cash every year, actually you might decide to shorten the repayment profile on a facility. But actually in most circumstances, let's take a hotel, for example. It's a big capital investment, and a company making that investment is likely to want to repay that over quite an extended period of time. When you're looking at something like that, it's amazing how much thought has to go into your application for funding, because it's not just the purchase of the hotel in that case. It's right, you need all the assets to actually get your hotel operational. You need the cutlery, the crockery, the beds, the curtains, There's so much that goes into this. So you have to make sure that your funding is right for actually delivering what you're trying to achieve.
So presumably if I'm going to be taking funding from FW or any other firms in different niches, I need to make sure my business is debt ready and do a fair bit of work to make sure we're ready for the lending on that particular asset or project. Can you chat us through what that might mean?
To get yourself ready to go through that process, firstly, sometimes it's really useful just to have an early stage conversation. If there's a spark in your mind that you want to do something, I'm a real advocate of people picking up the phone and going, right, I'm thinking of doing this. What do you reckon? And have a sensible conversation about it. Absolutely, as you go through the process, then the expectations of a funder are quite extensive, but it's our job as funders to actually make it as straightforward and simple as possible. But we would expect the business to understand their business, their environment that they're in, the competitive market, how they're going to make it succeed as far as they're ever able to predict that, and also a really good understanding of the financials of the project and the business. And that's sometimes something we need to guide a little bit on.
As always, in communication, where clients are talking early and talking often, that always helps. And often it's about us as outside advisors having a conversation so we can understand some of the implicit knowledge they have about their project or about their company or about the opportunity that may not always be spelled out explicitly, or we may not understand without a good conversation.
Yeah, they need to help us understand what they're trying to achieve. And I've had circumstances in the past where the business has been so complicated, and they've been pitching the business to me, and they know what it is, but they can't demonstrate to me so I understand it. That's more typically in the tech space,
Sure.
where you have some amazing entrepreneurs with this amazing technology, and they're trying to pitch that to me as somebody who's going to lend them some money. But actually, you're sitting there, or I'm sitting there like 20 minutes later thinking, I still don't actually know the application for what they're trying to do here.
Yeah.
And it's actually incumbent on me to say that and be honest, and not walk out of the room and go, oh gosh, I have no clue what I've just listened to there. For me, it's about, look, I'm really sorry, but for me to invest in your business, I really need a bit of a more simplistic understanding of where am I going to see your product? How does that actually work in real life?
I think there's a broader lesson in that, actually, because it's a learning point for the company, because in my experience, companies that struggle to explain their value to their peers or to their funders are also ones who struggle to explain their value to their potential clients. So, yeah, it's a key part of
Very much
business.
so. I think it can prohibit funding, actually,
Yeah.
if they can't explain, because I can't back it if I don't know what it is. And seriously, I felt really awkward. I've had a few instances where that's been the case. And I thought, oh gosh, I feel a bit daft here, because they're exceptionally intelligent and their product is phenomenal. I just don't get it.
Okay.
And I felt awful, seriously. But I've had to say, as a layman, how do I understand this? Where do I see it? But when they understand why I'm asking that question, they go, well, actually, that's a really fair comment. If we're looking for investment, the investor needs to understand it.
So, David, I come to you or another lender. I have a great opportunity to grow the business, develop a new line, or scale. What do I need to do to make that easy for you?
Definitely communicate what you're trying to achieve. If you've got some form of business plan, even if it's just a few pages of high-level slides and points around what you're trying to do and what does the funding look like for that and what do the financial metrics look like, that is really, really useful to have. I'm not saying you need to go into a huge amount of depth at an early stage, but having something that is very simple and plain and explains what you're trying to do, that you can whiz across to a funder so you can get a quick look and go, right, okay, I understand, that looks interesting, let's develop the conversation. Because if we need more, which if we're going to take a transaction forward, we probably will, we'll ask for that and we'll say what we need. So rather than go to the expense of having like bells and whistles, everything at a really early stage, get an outline first so it's really clearly presented, and then we can talk about what further information might be needed in terms of that business plan and the due diligence that we might need to do.
The more you chat to your potential lenders early, the more you understand their language, the more they understand you, and the more you know what they're going to be looking for when the moment comes that you say, let's see if we can do something.
The communication is really, really key. And it's also using the power of the networks that those people might have. There'll be a lot of cases where people come to me and they're not quite ready for debt, but I can understand where they are in that cycle, in their journey, if you like, within their business. And it may not be something I could do, but I might know somebody else who would be really interested in having a conversation with them. And I can then facilitate that introduction. I think the ecosystem around supporting business in this country is phenomenally strong. And that's why I talk about the power of the networks. I think people in our sector or our industry are really keen to see the impact of businesses growing and seeing the UK business ecosystem continue to strengthen. We're there to support in the best way that we can.
And that brings us back to where we started about the importance of crossing the line, making those approaches, because in effect, you're not actually introducing yourself to one person, but potentially to them and 3 or 4 other people who, in ways completely unanticipated by you, could help you in your business.
Exactly so.
There's one question that we ask every single guest on this podcast, and that is, what is your strongest professional opinion?
So my strongest professional opinion is definitely crossing the line when you come to look at business development opportunities.
And what does that mean?
Crossing the line is when you have somebody in your mind that you want to see that might be across a crowded room.
Sure.
And you know them and you know their business is fantastic and you want an opportunity to go and engage with them.
Yeah.
Crossing the line is actually going over to them and saying that and introducing yourself rather than staying behind the line and avoiding the situation.
Be bold, take a chance.
Definitely.
Take the leap.
Absolutely right. I think you'll regret it if you don't.
100%. Are there any occasions that you can think back to where you're in that position, you saw someone you thought, I really need to chat to them, and you're unsure, but you crossed that line and good things happened?
Very much so. There are lots of times when I didn't do it, and I think that's when I walked out of the event and sort of kicked myself for not having done it.
Sure.
And it taught me to go, right, okay, just be bold. And there was a situation when there was a very major player in a particular industry, phenomenal business opportunity for the bank that I was working with at the time.
Yeah.
And I was so nervous. I was looking at him thinking, if only I had the courage to get across and have that conversation and introduce myself. And I just went, just do it. Just go across. I had a quick beer and just got the courage up. It was a bit like that. Definitely needed to get the courage up. He was a very, very influential businessman, so I felt very intimidated. I went over to him and introduced myself, and he was the most engaging person, probably, one of the most engaging I've ever met. And it led to a very significant business opportunity off the back of it. Fantastic. And it just taught me that, sometimes you do just need the courage to cross that line. It's easy to stand behind it and look and think, I wish I could do that. Do it.
Have you ever looked across the room, plucked up your courage, crossed the line, and been blown out?
Yeah.
Oh, really?
Yeah, absolutely.
Okay.
Well, sometimes people just aren't in the right frame of mind, or they don't really want you to disturb them or whatever. It's rare. In most situations, people are going to be pretty engaged and they're going to be happy that you've made the effort.
Yeah.
But sometimes, you do get a little bit of a knockback. I think that's life, isn't it?
Yeah,
but that's fair enough. You walk away knowing you've tried.
You're still alive, yeah.
Absolutely. And I think that's one of the most powerful things, actually. If you have the courage and the tenacity just to give it a go, Sometimes it's going to work. Sometimes it might not quite go your way. Most times you'll be okay.
Courage is a muscle, isn't it?
Definitely.
The more you exercise it, the better you become. What is your spiciest personal opinion that you would nonetheless defend to the death?
It's got to be related to musical theatre.
Musical theatre, okay?
I know a lot of people have very, very strong opinions about musical theatre. I sing in a show choir. I think people look at me like with slightly raised eyebrows sometimes.
Okay.
When I say that, it's joyous.
If I'm a skeptic, if I'm among the unconverted, what musical should I watch to kind of bring me into the land of sunlight and musical
Oh,
appreciation?
goodness me. That's a really tough question. Because musical theatre can take you through a whole range of emotions.
Sure.
And if you want to cry, if you want to be a little bit like down but into the story and make you a little bit sad and teary, but
What's the
joyous as
moderation?
well,
Yeah.
Les Miserables, I would say, or a good Miss Saigon. You can cry in that. If you want something joyous and uplifting where you're just going to smile your way through the whole thing, it's got to be Six.
And Andrew Lloyd Webber, is he your king?
No.
No. Okay.
That's very controversial. I'm not sure I
Now
can
that
say
is
that.
a spicy opinion.
No, absolutely. You know, there are some. He's amazing at what he does, and actually, it's funny you should say that. I did see Phantom of the Opera for the first time last year, and I didn't think I was going to enjoy it.
Uh-huh.
It was phenomenal. It was absolutely brilliant, but not necessarily my favourite.
For the record, I feel similarly about opera. If you're not a fan, you'll hate it. But once you get it and the hook gets in you, you have to be loud and unashamed once you're part of the cult.
Give it a go.
Yeah. Thank you, David. That was a great chat, and I think went a long way towards answering the question that we asked ourselves at the top of the podcast, which is, I have great plans for the business. How can I find funding to achieve them? Thanks for your time.
Thank you.
So that's us for this episode, and I look forward to seeing you all again. Thanks.